Tyler, the utility scale renewable energy market is tough right now. Cost of capital has gone up with rising interest rates. That's affected a lot of the companies that own and invest in the utility scale projects and created some opportunities, but also I think maybe created some what might look like really deep value opportunities that when you start peeling back the layers, maybe aren't as attractive as they seem. And one of those is NextEra Energy Partners that looks dirt cheap, but you and I both agree maybe a little more risk there than investors might realize. You ready to dig into the details?
Yeah, it's a story we've been following. There's some very, I would say, interesting points to be made here, and some very surprising numbers when you start to dig into it. But the takeaway is pretty consistent with what we've been saying for a while.
I'm Jason Hall. This is Investing Unscripted. Tyler Crow is here with me. This video exists because of our partnership with The Motley Fool. The Motley Fool is the sponsor of this video. And if you're looking for even more great stock ideas, go to our special link. It's fool.com/unscripted. If you go to that link, you can get access to the Motley Fool's 10 best stocks to buy right now. Be sure to check that link out. You see it right there on the screen. Okay, Tyler. So we've talked about this before. Anybody that's watched our other videos on NextEra Energy Partners, I do see some risk reward opportunity. Probably, I think more reward than you do. You probably see more risk than I do. But what I want to get into the detail here is the stock price has come down a ton because of some concern that the market has about the company's ability to mainly continue to pay its dividend. Management's been firm that they're going to be able to continue to pay the dividend and even grow it. The market at this point, this is a metric, price to book value, that we're going to use to highlight what makes it look like it's incredibly cheap. And the stock now trades for essentially, from a liquidation value perspective, works out to 74 cents on the dollar. For every dollar of assets that it owns, the market says we will pay you 74 cents right now. That is exceptionally cheap. And in fairness, it's a metric that you and I have both used on this channel to highlight stocks that we do think are dirt cheap and that are really good opportunities to invest when the multiple returns back to historical norms. So let's kind of unpack the story here, everything that's happened that brought us to this point, and where you come down on seeing this as more of the risk, maybe value trap versus the deep discount opportunity.
The story basically is that Nextera Energy Partners is this financing vehicle for a parent company, Nextera Energy. It for a longest time they were able to, they call it dropping down assets, which basically means sell it down to Nextera Energy Partners, which they own. Nextera Energy Partners then owns the assets, which are typically solar or wind utility scale sort of projects. And then they just own them. They run the cash flows and then they finance it through debt and equity or whatever to create a steady stream of cash flows that investors want because it's a relatively high yield. And if you can grow that dividend and maintain a relatively low yield for the parent company, it's an attractive thing, right? Because they can drop down the cash flows from that asset are cheaper than the whatever it costs to do it. And as a result, it makes the financial math work. That financial math works when interest rates were low because cost of capital is cheap and equity was also cheap because, hey, they said, look, I can't really get anything from owning debt. So sure, we'll take 4.5 or 5% yield on equity for this financing vehicle. But in a higher interest rate environment, compounded with, kind of a thinning cash profile, I guess, if you will, the equity for XR Energy Partners all of a sudden doesn't look as valued as it did today. And now we have a yield of about 12.6%. And the market is basically saying, we don't think you can keep doing what you're doing.
Yeah, I think that's the key. And I've pulled up on the screen the dividend yield. Like I said, so it's over 12%, depending on exactly the screen you're looking at and the price of the stock at the moment you're looking at it. And that's exceptionally high. And the funny thing about it, Tyler, like you said, is it can look appealing, especially when you say, wow, this business is trading for 74 cents on the dollar. Part of the story that we haven't really specifically talked about directly, you and I have done other videos about it where we've gone through like bucket by bucket looking at NextEra Energy Partners debt profile because they've dropped out those assets that have been dropped down to them from NextEra Energy, the parent company, have been paid for one of two ways. They've either taken on debt or they've issued equity to do it. And when the stock price was very high, issuing equity made sense because again, the cost of capital based on the yield was very low. And we've come through that period where interest rates were super low, so they could get some really attractive deals. It's a different world out there to refinance that debt. And we look at their ladder of debt maturities over the next 3 or 4 years, and we've already started to see debt costs to refinance a certain debt that's going to mature tripling or more at current market rates, interest rates. So that's created a lot of headwind for their ability to drop down, and because they can't use equity now because the 12% yield on their stock price and management's commitment to maintain and even continue to grow that dividend payout. So you combine that with where we are, and the market is essentially saying, "I don't believe you." Right? Is really what it boils down to. And so far, management has been right and the market's been wrong. When do you think the story changes? And if you were to kind of lay out the case, that your concerns, what's going to come to a head here? What do you think changes the story?
Well, the thing that management has kept on doing is basically they've said that they're going to keep growing its dividend. And if I look at the most recent quarter, and I understand that when it comes to utilities and these special financing vehicles, that the traditional cash flow statement doesn't accurately reflect anything. I don't believe that in a word of it. Like a gap compliant cash flow statement is perfectly fine for just about any business. You just kind of have to adjust your expectations. But this is where the thing that really gets me. Over the past 12 months, NextEra Energy Partners has brought in $727 million worth in operating cash. It paid out $753 million in dividends. Those numbers don't add. And that's before anything else, before any CapEx, before any other spending that has to do is its dividend is more than it's paying out or is more than it's coming in the door right now. And that has to be externally financed. We just talked about higher costs of capital. Those numbers don't add. So in my opinion, there has to be some sort of dividend cut. And then to the book value, why it could be cheaper than it is. And this is probably something that, we can maybe hash out a little bit more, but book value is very much dependent on the future cash flows of an asset. And the future cash flows of an asset also greatly depend on how much the cost of capital at which it was financed. And so if I've got an asset that I bought at, I don't know, $1 billion and it yielded 7% at the time, 3% debt, that makes it really easy to do. But if all of a sudden my debt is 6%, all of a sudden, that asset suddenly is worth a lot less because the future cash flows are much, much less. And so there's part of me that when you look at book value is not etched in stone or anything like that. It's very much
It doesn't
contingent
stand
on
on its own. There are other things that come into play. Right.
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 And
I think
so
that's exactly right. And I think an example of a stock that we've talked about here, that we've said using the book value as the proxy for, this is a stock that looks really cheap, Canadian Solar, right? So this is a company that's on the other side of the renewable business from NextEra Energy Partners. NextEra Energy Partners, they invest in and operate these utility scale projects, including solar. Canadian Solar, they manufacture the panels and some energy storage, and they also develop the utility scale projects, looking for a NextEra Energy Partners or a NextEra Energy or a Brookfield Renewable to buy them. Right? They would develop them with the intent to sell them to these producers. So the key for both is, where does the debt profile fit into your capital stack? How big of a percentage of your capital is it? And how much is it going to cost you in interest dollars to service it? And that's the difference to me with Canadian Solar versus NextEra Energy Partners. Canadian Solar doesn't have a big fat dividend as part of its investment promise to shareholders. So it doesn't have a lot of its cash flows committed to paying back to shareholders, that if you cut it, you undermine that value that further reduces the way your stock is valued. It's a completely different story for NextEra Energy Partners. Management has doubled down on this dividend and growing it so much that their refusal to cut the dividend is a major hindrance for their ability to continue to fund the business over the long term, especially because debt is such a big part of its capital stack. And that means interest expense as a cash expense is only going to continue to get bigger. So their ability to grow the dividend is further hindered because they're going to have to take more of their already insufficient cash flows, as you pointed out, over the trailing 4 quarters to service debt that's going to continue to get more expensive. And guess who you have to pay first? You have to
debt.
pay your lenders before you pay anybody, because if you don't, they get your business. You default. Bad things happen when that happens. Go back and look at what happened. You look at an energy company that the same story played out and then it undermined a massive amount of value for investors. Say it for me. You know which one I'm going to talk about. Kinder Morgan.
I was going to say Sun Edison, but there's plenty of examples.
Well, that was a bankruptcy. But Kinder Morgan, I think, is a good example of management can promise you your dividend all day long. But when your lender draws the line, your lender wins. And that's the risk that investors really need to consider when it comes to NextEra Energy right now, when it comes to NextEra Energy Partners right now.